Prime Minister Narendra Modi is faced with the challenge to improve India's ailing infrastructure, which according to the India Infrastructure Bank will cost $750 billion. That's more than twice the size of Singapore's economy and 5 times the existing $144 billion of bank loans to Indian infrastructure projects. The solution is to rethink current funding techniques, according to S.B. Nayar, the chairman of India Infrastructure Finance Company Limited. He pointed out the critical requirement that seems difficult for the current system to meet, advising that the government should establish more lenders for specific areas of infrastructure, woo private investors, including from overseas, and allow his company to target at least an 8% share of infrastructure loans from 3% now. Nayar contrasted the growth in the size of China's banks with comparatively smaller Indian lenders, which are also tackling rising bad debts. He said Modi's agenda is focused on stoking investment, including clearing a backlog of Rs 13.5 trillion of stalled projects. Nayar said there will be a huge requirement for railways, ports and shipping, airports and roads. Knowing that banks will step back, we need to make a more active role. India's goal is to spend $1 trillion on roads, ports, power and other infrastructure from 2012 to 2017. About 75% of this would need to be financed through debt, according to Nayar, leading to the figure of $750 billion. Modi government has said infrastructure outlays will rise Rs 70,000 crore in the year through March 2016. Other steps include spending Rs 20,000 crore to establish a fund to spur infrastructure lending and permitting dedicated tax-free bonds. The average yield on 5-year top-rated rupee corporate bonds is up 15 basis points to 8.49% from this year's low. Higher yields may hurt Modi's push to close the gap to China.